This is Kali Persall, editor of Institutional Investing in Infrastructure, and I'm here today with Hugo Llewelyn, CEO of Newcore Capital. Thanks so much, Hugo, for being here today. Did you want to say anything about the firm, your role, or just kick it off with an introduction?
Hi, Kali. Very good to be here. Thanks for inviting me on your podcast and pleased to be doing this. Yeah, Newcore Capital, it's been going since 2011. We invest in UK social infrastructure and in particular the real estate that underpins and enables it to happen. So I'm sure we'll explore what we mean by that in a minute. And it's worth just saying we are a B Corp, which will be an ethical business movement familiar to many of your listeners. We sit in the top 1% of B Corps globally and the highest scoring real assets manager. And it's been very helpful for us as our business has gone along.
Perfect. Thanks so much for that. So we're seeing lines being increasingly blurred between real estate and infrastructure. Can you just talk about some of the distinctions between infrastructure and real estate investment?
Yes, certainly. That's a very good question. We get asked it a lot. And the way that I would describe it actually is slightly different. For me, infrastructure is a theme like living or working or leisure, whatever. And there are different ways that you can get exposure to that theme, and whether it's social infrastructure or economic infrastructure or digital infrastructure. The three ways that you can get exposure to it are through owning shares in a company that operates and delivers those services. You can own the property that is leased to those companies, or maybe it's to the government or a national provider. And you can lend money either to the property or to the equity shareholders. And those are your three means. So there isn't a conflict between real estate and infrastructure. We are the real estate of infrastructure. And I often wonder if some investors or investment managers get confused by thinking that infrastructure is itself a way of investing. But actually, that isn't the case. You have to take your risk through equity, property, or bonds and debt.
So you were recently featured on Sky News talking about Thames Water, which is the UK's largest water and wastewater company. You were talking about it in the context of investment. So I understand as well as a massive debt pile, Thames Water also had reported a recent 40% spike in sewage spills. Can you talk about the importance of financial sustainability in infrastructure investment?
Yeah, absolutely. And the first thing to say is that Thames Water is a private equity investment, and obviously economic infrastructure is the theme. So just picking up what I was saying before. The next thing is that in the UK, the regulators allowed investment managers and those running the syndicates or the companies themselves to lever the regulated asset base of our economic infrastructure up to ridiculously high levels, 85% against the regulated asset base. And because pre Q4 2022, when we had this repricing of the cost of capital, before that time, the discount rates were going down and down. So the regulated asset values were going up and up. The lenders were lending more and more. And the owners of some of those companies were trying to take out as much income as they could through shareholder loans or whatever. The companies themselves got underinvested and overvalued. And what happened, if we take Thames as an example, is all public knowledge. The investors who bought it in the late teens from its previous owner manager had paid about 18 to 20 billion pounds for the asset. And that was about 5 billion of equity and about 15 billion of debt. But it was a completely unsustainable price. And we've recently seen equity being written off completely, and now a massive argument amongst the debt holders of who is going to take priority, who's going to get the money back, and who's going to get a haircut when the asset gets recapitalized or nationalized. And it's not pretty. And it's also not pretty for the consumers of water. And I live in the Thames Valley myself, so one of them myself. It's not pretty for environmentalists and just the environment in general. We're given a lot of sewage and wastewater is being sort of pumped into the rivers untreated. So that is a classic case of over-levered private equity, and lessons are learned. And the trouble is, of course, you need one, if you're an equity investor, they take equity, so they could lose all their money. The higher levels of the bond in the capital structure, same again. But the output, because it is a public asset in a sense, providing our water, is not really acceptable. And I think there needs to be much more responsibility amongst investors in the theme of infrastructure than there has been in the rather sort of high octane, high leverage world that we've been inhabiting since the beginning of quantitative easing.
Talking about over-levered private equity, is this Thames Water situation a common one, or do you see this happening um, fairly often, or are there certain factors that have kind of led to this specific case?
But taking the water industry as a whole, it is a common feature. And that is both privately owned businesses and indeed the leverage in some of so Welsh Water, for example, is a publicly owned asset, and that's got high leverage in it as well. And they would say that their leverage is about 60% of its regulated asset base, and that's quite low. And it is compared to Thames or Southern or others who are up in the mid 80s. But the problem is, we, as the rest of the Western world, have rising interest rates and very much more important, rising bond rates as well. And that means that the service cost of that debt, if you also include the need for working capital to pay for capex upgrading, future-proofing, decarbonizing, the numbers don't stack up. So something has got to give.
Absolutely. Thanks for discussing that too. So, really, I just wanted to see if you had any future-facing thoughts, any final comments on what we talked about, or anything else that you're seeing for 2025, maybe?
Yes, absolutely. The UK is like the rest of the Western world in a cost of living squeeze, and that puts pressure on all services and other businesses and public sector provision. So, in navigating that, one wants to hold on to the following tenets, which are affordability and sustainability and assets that are essential to the future of society. Now, what is the future of society? It's changing. Technology is playing a part. Demographics are playing a part. AI is playing a part as well. But in our view, if you can invest in the most primary needs of society, so in a sense, the bottom of Maslow's hierarchy of needs, that pyramid, then that might be a good strategy to weave one's way through inflation, higher cost of gilts, and all the risks that are out there. So that's what we do, and so we're going to keep sticking to the knitting and doing that.
Well, great. That's a good message to leave off on, I think. So, thank you so much, Hugo, for taking time to join me and talk about this. It's really a pleasure to have you on.
Thanks, Kali, so much. Very good to see you. Thanks for inviting me on your show.